Hello, everybody. Happy Friday. Ron Benning, real estate broker, and I am back for another weekly rate update with loan broker Lee Hurst.
Good morning.
So, today, what we're going to do is we're going to talk a little bit about what has happened with mortgage trends this week and why. So, Lee, do you want to give us a little update?
Sure. So we've been getting some hot inflation data. So we've seen about a 0.25% increase week over week. And just today, the PPI number came out, the producer price index, which indicates wholesale inflation, and it came in a lot hotter than what was expected. So the bond traders saw that. They felt that was an inflationary number. They're selling off some bonds, and that's raising that yield, which directly increases interest rates. If you follow that 10-year treasury, last week it was at about 4.1 and it's about 4.3. So that really realized that 0.25% increase if you want to track rates with that 10-year treasury yield.
Why don't we just have a quick refresher on that relationship between the 10-year treasury yield and interest rates?
So it's a bond fund, and it's probably the closest indicator unless you can specifically track mortgage-backed securities, and that's not really readily available. So a lot of people pull up that 10-year treasury yield. And in general, bond traders, whether they're buying mortgages or 10-year treasuries, they kind of follow the same pattern. They're either buying them more or selling them. If they're selling them off, the bond traders have to raise that yield, which raises interest rates. If bond traders are buying bonds, then they can lower that yield, which will lower interest rates.
So, kind of, if I'm understanding it right, in a layman's explanation, is that when the bond traders think that the market is getting worse, they're going to be
They're selling off their bonds. So if there's inflationary data that shows inflation isn't cooling, they don't like that. That's negative news for them, and they'll sell off their bonds. And then we'll have to raise the yield on those bonds, which ultimately raises 30-year fixed rates and 15-year fixed rates and all mortgages.
okay, great. So, before we jump into the actual interest rates, let's talk a little bit about what those assumptions are just to make sure that nobody is feeling, misled about the rate sheet that we're going to put up.
Yeah, so there's a lot of factors that affect the interest rate, and so we have to make some certain assumptions. And for what we call a base rate would be for an owner-occupied single-family home, 20% down, excellent credit like FICO 780 or above. So meeting all those marks, and if your credit score is lower or you're putting less down, the rate could be slightly higher. So those are some basic assumptions when we start talking about these interest rates. So this is our today's rate sheet, we'll call it. And the top interest rate is for that owner occupied 30-year fixed. And last week we were at 6.5. This week we're at 6.75 with just under a point. So we have seen that 0.25% interest rate. The next rate down is for a non-owner occupied or an investment property that's a one unit. And so it's about 0.5% higher than what that base owner occupied rate would be. So we're quoting 7.25 today. And then if you add multi-units, meaning a 2 to 4 unit property, investment property, that's about another 0.1% higher on interest rate. So today we're at 7.375 with a point.
Okay, great. So that kind of explains things a little bit. So if you look on the screen, you can see Lee's phone number and his licensing information. My contact information and licensing information will also be down below in the description. So if you like getting these rate updates and you want to be seeing them each week, please subscribe to the channel and we'll try to bring those to you. We do these on Fridays and we are both available this weekend. What's the best number for them to reach you out this weekend, Lee?
You can call or text me anytime on my cell phone, and that number is 916-834-1282.
Okay, and I can be reached at 916-730-3846. We appreciate you tuning in, and we will see you next Friday with the next rate update.
Thanks, everyone.